Welcome to New Vision's November Grain Marketing Webinar. This is a recap following the USDA report on last Tuesday, November 10th. Today's webinar, here's the agenda that we're going to be going through. The corn and soybean yield and production estimates as given by the USDA on November 10th report. They also updated the corn supply and demand tables and outlooks for future adjustments. We'll look at the corn and soybean supply and demand in detail. You know, the supply side now, from a production standpoint, we will not have another production estimate for 2020 in the December report. That'll strictly be supply and demand. So the next production updates will not come until mid-January. So the market has time now to kind of wonder what's coming down the road. Also on the demand side, we've had a very aggressive export program led by the Chinese on both corn and soybeans out of the US. Is there more demand coming from China or from other parts of the world? And as far as China, the purchases that they have on the books now, are they finished? Some people think that they have more corn to buy, some that they think they have more soybeans to buy. The million-dollar question is, are they going to take everything that they've purchased? So we have to watch closely our grain shipments down the road. We're going to take a look at the USA corn and export programs, where they're at right now, a lot of sales on the books, and we'll also kind of compare on how our shipments are doing year to date on their weekly basis. 2021, we are in the middle of a La Nina. We'll talk a little bit about the current status of the La Nina and what it may mean to corn and soybean production estimates for South America, especially southern Brazil and Argentina. They seem to be the areas affected most by La Ninas. We'll look at corn and soybean price and basis outlooks, and we'll look at some grain marketing opportunities, hopefully to help you in your operation. And finally, market potential. The reports that were released on November 10th definitely heightened the awareness of the world as far as U.S. ending stock projections and what it might mean for prices down the road. The Q&A during the Zoom presentations are kind of hard to do one-on-one, but we would encourage you to submit any questions or comments you might have following the webinar by email, by phone call, or text message. As we get started then, here is how the USDA gathered the information for this report. Really two sources. The operator reported survey, or basically that's from farm clients that they contacted, 7,791 responses in that area. And from the field survey, the actual plots that they checked for the objective yield data, 3,930. So 11,721 total respondents to this survey, to the surveys for this report. Basically 2/3 or 66.5% came from the farm side and 1/3 from the actual field plots. You notice they do use satellite imagery. Earlier in the crop year, for this case, that was not used. When we look at the numbers of the report, we'll look at the table here to start out, and I'll direct your attention to the far right-hand side of the screen. These were the yield and production estimates that the USDA gave us in the October 9th report. So you can see the corn yield nationwide at that time was projected at 178.4. Going into this report, the trade was looking for a slightly smaller yield of 177.7 for an average estimate. You know, roughly about 6 to 7 tenths of a bushel less. And they were looking at the fact that a lot of the northern plains had had a dry part of late July, dry during the month of August, and the crop just seemed to mature a little bit quicker, and they didn't think the yields were going to be maximized. USDA gave quite a friendly surprise in that they came out with a corn yield for a national average of 175.8, down 2.6 bushel per acre from the October estimate. One of the largest drops that we've ever seen from October to November, month-to-month change. On the soybean side, the October 9th estimate, 51.9 bushel per acre nationwide. Trade once again was looking for a slightly smaller estimate of 51.6 on the average side, down about 3/10 of a bushel. And the USDA came out with another surprise, dropping the yield 1.2 bushel per acre from 51.9 in October to 50.7 in the November report. Of course, harvested acres were left unchanged, so the smaller yields resulted in smaller total production numbers, 14.5 billion on the corn side, 4.17 on the soybean side. Now we'll go into detail on the supply and demand tables in just a few minutes here, but a big overview from 35,000 feet here. When we look at the ending stock projections and how they've changed from the October to November report, remember these ending stock projections are based on the USDA crop year, starts on September 1st, ends on August 31st, and this crop year now ends on August 31st, 2021. In the October 9th report, ending stocks on corn projected at 2.167 billion bushel. The trade was looking for an average estimate of about 2.033. So we're getting close to that 2 billion bushel area, and the market was really wondering if we were going to go below that. Quite a surprise by the USDA. They came in with an ending stock projection of 1.702, down 465 million bushel from the October estimate. The largest October to November change in ending stocks in history. On the soybean side, 290 million bushel of ending stock projected in the October 9th report. The average trade estimate was 235 million. Now that's a drop of about 55 million bushel, and where a lot of that was coming from, the reason for the big drop expected by the trade. We have two sets of export inspection reports that are put out by the government. Each Monday, we get an export inspections report, and then once a month, the month following, we get a census export report to kind of double check the figures. When the USDA released the September census report, it showed soybean inspections of about 52 million bushel more than what the weekly inspection reports had showed if you totaled those up. So the trade was expecting a pretty good increase because normally the USDA trades off or puts their balance tables together based on the census numbers rather than the inspection numbers. This, along with the thought that we were going to have a slightly smaller crop, is why they were looking for that type of drop. But the USDA came in even more aggressive there, 45 million below the average trade estimate at 190 million bushel for ending stocks, down 100 million bushel from the October 9th report. Now that was a drop of 100 million bushel. That's about the second biggest drop in history from October to November reports. So definite surprises, and that's why, if you remember the day of the report, very strong market as the trade had a chance to digest these numbers. Here's a national map of the corn yields, and this compares our October to November yields as released by the USDA. Once again, total crop now nationwide projected at 175.8, down 2.6 bushels per acre versus the October estimate. All of the states in yellow showed lower corn yields than October. States in white, for instance, like Minnesota, 202 bushel, unchanged from the October estimate. The only green state that showed an increase was Oklahoma. Now they don't raise a lot of corn down there, but they were the only ones that showed an increase versus the October numbers. Here we have R.J. O'Brien's analysis of what to expect down the road. Now we have a unique situation this year where corn yields from August to September were lower, from September to October were lower, and October to November lower. So what does that mean, or what it might mean to that final production number that comes out in mid-January? And what we have here are years, analog years that had those same progression. The gray bars are August to September, lower. The blue bars, September to October, lower on corn yield, and the green bars, lower on October to November. Now you see the zero line right here. So anything below means that the yield continued to go down. So what happened in the final report? Well, we can see if we go back to 1970 and 1983, yields actually ended up higher than the November estimate when they made that final projection in January. But if you look at the last 4 consecutive years where we had this type of projection, where August was lower than September was lower than August, October lower than September, November lower than October, we also found January to be lower than November, that final crop report. So this puts a little doubt in the minds of a lot of people as they look at these tables. Could that yield in January actually come down a little bit more, reduce the supply of corn, and possibly drop that ending stock number slightly lower yet? Here's the actual supply and demand tables on corn from the USDA. Now, the columns on your left is basically the end of last crop year. So we ended up with 1.955 billion bushel of corn on August 31st, average price of $3.56. Then on your right-hand side, we have the October supply and demand table, and then the November supply and demand table, the one that was released last Tuesday. Here's our 2.6 bushel per acre decline in yields from 178.4 to 175.8. Harvested acres left unchanged at 82.5 million. That took 215 million bushel of corn out of the production figure, or basically out of the supply. Now, what did the USDA adjust as far as demand? Feed and residual was dropped 75 million bushel, and that's pretty typical. As the price goes higher, you'd expect possibly a little more rationing on corn and feed demand, and with this large number, that comes into the feed residual area. Ethanol was left unchanged at 5.050. Exports, surprise of the report, increased 325 million bushel from 2.325 in October to 2.650, which, if achieved, would be an all-time record for U.S. corn exports in one year in recent history. So we lost 250 bushel of supply. Between the reduction in feed residual and an increase of exports, we gained 250 million of demand. Combination of the two, and dropped ending stock 465 million bushel. Once again, the largest September to October to November drop in history, taking the ending stocks down to 1.702, raising the price projection from $3.60 in the October report up to $4 a bushel for this crop year. Now, we always talk about using this as a guide in your marketing plan, and I'll continue to say that. Now your target should be to try and achieve sales above the at or above the $4 area for cash corn as we go through this crop year. Now, as we go forward here are the same areas that we want to watch. Of course, in that January report, we'll look at what the final yield is. But in December, for the supply and demand report, watch what the USDA possibly does as far as changes to feed residual, to corn for ethanol, and to exports. Those are really the three demand categories you need to watch on corn. Now, another thing that we like to talk about are the stocks to use ratio. You'll hear a lot of talk in the marketplace about that these days. How you determine that is take your ending stock number, in this case 1.702, divide that by your total demand of 14.825 billion bushel. You'll end up with a stocks to use ratio on corn for now in this November report of 11.5. Now that's going in the right direction, because that number in October was around 14.4. So if we look at a historical perspective of ending stocks on corn, I think it's important to realize, we're definitely in a trend now where this would be the 5th consecutive year where ending stocks of corn are coming down. But the 1.702, if you look at that from a historical basis over the last 20 years or so, you can see we're not really short corn. In fact, there's been several years where the ending stocks were much lower than what they're projected to be for this year. Now, stocks to use ratio at 11.5, we're going in the right direction. That's also been dropping each year, which is good. That's supportive to prices. But when we look at where that stocks to use ratio on corn needs to be to really get the market excited, we look at some analysis that StoneX, formerly FC Stone, put together. Arlen Suderman is a contact that we have that does some excellent analysis. And this is an interesting chart that Arlen puts together that shows the stocks to use ratios and then compares what the average cash price tends to be from a historical perspective. And you can see here a month ago when we were at 14.4, yeah, the trade was thinking, or the USDA's average price was around 360. Now, as we've moved to 11.5, we see that line gradually work up, and now the average price projection is around $4. But you can also see from this chart that really, for the corn market to get excited, to want to start trading above, say, $4.50 up to $5, $6, $7, we need to see that stocks to use ratio get under 9% or lower. Still at 11.5. So you know, it's supportive to prices, but we have to be careful about getting too bullish on corn right now unless something changes down the road. Here's our national map on soybeans. Once again, the states in yellow, all reporting soybean yields lower than the October report. Nationwide, USDA down 1.2 bushel per acre to 50.7. Minnesota yield was also a yellow state on soybeans, down 1 bushel to 51, which would now actually make the soybean yield for Minnesota a bushel under the previous record of 52. I forgot to mention the corn yield of 202 for Minnesota would be an all-time record for the state. Previous record was 194. So an excellent crop and really a very good bean crop also. The states in green, you can see some of the Delta states had increases in soybean yield versus October, but for the most part, the heart of the Midwest, the heart of the corn and soybean belt, yields were all reduced. Now there's been a lot of discussion. What caused these yield declines from October to November? And really the one consensus that a lot of people have, at least for part of the reason, is this was a unique year in that both the corn harvest moisture and the soybean harvest moisture were lower than expected and lower than normal. We've heard reports across the country of a lot of soybeans harvested 8 to 10% moisture versus 13 or 14% moisture. Less water was harvested in that soybean seed. Likewise on corn, even locally, a lot of corn really didn't need to see a dryer because it was coming out of the field at 14 to 15, maybe 16% moisture, compared to an average year where it's 20 to 22. So less water was harvested, less grain in the bins. Now, as we go through and empty bins out and everything across the country, will we find more bushels due to heavier test weight? That remains to be seen. But for now, I think the market justifies a lot of these yield reductions in a drier crop. Same analysis on soybeans that we looked at on corn from R.J. O'Brien. And once again, you know, here's our zero line on yield. This would be if the yields stayed the same in all these reports. Here's analog years on soybeans, where once again, yields from August to September went lower, September to October went lower, October to November went lower, which is the case so far this year. Now, what happened with soybean yields as we went to that final crop production report in January? And you can see it's more of a mixed bag on corn. Early on, it was pretty consistent that if we were lower in the preceding months, we would be lower in January. But if you look at the last few years that we've had these type of patterns, we've actually found slight increases in soybean yield in that January report. Will that happen again this year? Time will tell, and we'll have to wait to see. Here's our supply and demand tables on soybeans. Once again, on the left, this is where we ended last year. Ending stocks of 523 million, average price of 857. Here is our October column of supply and demand estimates by the USDA and the most recent numbers in November from last week. Here's our 1.2 bushel per acre decline from 51.9 to 50.7 nationwide. Harvest of acres left unchanged at 82.3 million. So if we take those harvested acres times the new yield, we lose 98 million bushel of soybean production. That's a big change. And as we look at the demand side, nothing changed as far as crush or exports. They made a slight increase in seed and a slight reduction in residual, net of 2 million. So if we add that to our production change, we come up with 100 million less beans for ending stocks and a carryout projection of 190 million bushel. Average price projected at $10.40, up 60 cents a bushel from the October estimate. Now, a couple of interesting things here. When we went into these supply and demand reports, the trade was expecting or kind of hopeful for a slight increase in corn inspections, corn exports. USDA came out with a 325 million bushel increase on corn exports, not even talked about by anyone. But everybody was convinced into this report that we would see a higher soybean export number because we've been exporting beans at a very high pace, actually shipping the beans, and everything was going great. If you notice here, the USDA made no change on soybean exports. So what is the USDA telling us here? Well, the possibility is that they think the Brazilian crop is going to be okay, maybe not quite as late as what some of the trade feels, and that this demand from China will go to South America quicker? Or do they anticipate some cancellations from some of the Chinese sales that are on the books? Today, we don't know. What we do know is that the Brazilian crop was planted a little bit later. 10 to 14 days is the average planting window that was pushed back. So that could conceivably move their harvest window back. If that happens, there's a possibility we could see China being a customer out of the US longer, and there's a possibility that this export number on beans could go higher. I've seen some estimates of 2.3 to 2.4 billion bushel. You say, well, that can't happen, because if that happened, we would take our ending stocks to zero, and that will never happen. So if we get the idea that we're seeing more sales to China that are going to be executed and taken, and that carryout starts getting down to 150 million or less, we will see dramatic price increases, because at that point we have to ration demand or create enough pain on the users of soybeans that they find alternatives to use. But going forward, keep an eye on what this yield is. That will not come until the January report, but in December we'll get updates on the crush and on the exports and possibly on the ending stocks. Now, just this morning, on Monday the 16th, we had the crush report come out for the month of October. All-time record. I think it was close to 35 million bushel higher than what the trade was expecting. I think right now, based on those numbers and what we've seen for the crush of soybeans so far this year, it's going to be hard for the USDA not to increase this crush number of 2.18 in that December report. And I would also not be surprised to see a slight increase in exports. So, I think the market's definitely leaning that this 190 can still work a little bit lower. How much lower remains to be seen by if we execute all the business with China and our new sales put on. Now, quite honestly, I'll tell you that we like to use this average farm price as a target in your marketing plan. But quite honestly, the average farm price of 1040, if in fact you believe the 190 million or less carry out in the US, this 1040 price is too low. Because let's go back to the stocks to use ratio one more time now on soybean. To figure that out, we take the 190, the ending stocks, divided by the total demand of 4.519. That gives you a stocks to use ratio of soybeans of 4.2%. That would be the second tightest stocks to use ratio we've had in history for a November report. And quite honestly, that would indicate prices higher than the 1040. And of course, we have that in some cases already now, so it kind of fits in with what we're saying. Here's a longer term perspective of the US soybean ending stocks. Remember on corn, the 1.702, we're not out of corn. In fact, it wasn't even really on the tight side of being on corn. But look at the soybean chart. Keep in mind that 2 years ago, we had an ending stock projection of almost 900 million bushel. That's when we were in the throes of the trade war with China, and basically they had shut off trade with the US. Last year, we cut that almost in half down to 523, and now this year, dropping all the way down to 190 and stock to use ratio of 4.2. Huge, huge changes, huge opportunities as the soybean market has rallied. And once again, here's StoneX, the StoneX chart that compares stocks to use ratios and what that should mean to the average price. In the last report, I think it was around that 7.5% area. Now at 4.2%, you can kind of see once we get under 7% on a stocks to use ratio on soybeans, the market goes up sharply higher, because at that point, we are in a pre-rationing mode. And at 4.2%, we are on the doorsteps of having to ration demand. We'll talk more about what that may mean to price down the road, but for right now, this leaves very, very little room for error on the soybean side, meaning we really can't see that yield come down in January. And if we see new demand come in, it really affects this supply and demand table and stocks to use area in a very big way. Recapping then, just the corn and beans carryouts, ending stocks, and the stocks to use ratios. The soybeans are in red on this top one. Here's our ending stocks of 190. You can see we tend not to get that low a lot of cases. Yeah, we've been lower. Here's a 92 million, but we don't stay there very long. And when that happens, we tend to see price respond, so we slow down or ration usage. 1.702 on the corn, you know, it's pretty adequate. It's kind of middle of the road. It's definitely lower than what we've had, and that's why we had poor prices the last 4 years, but it's not down to a level where we're going to be anywhere close to having to ration corn today without new demand or other supply areas coming into corn. On the stocks to use ratio, here's our 4.2%. You can see the only time was in 2013-14 when that was at 2.7%, and the carry and the ending stocks at 92 million. We're not quite there yet. But if we don't slow down the shipments of beans, or if we have a problem with supply, things could get very interesting. So not a lot of room for error there. Let's talk briefly about exports out of the U.S. Here's a chart that combines corn in the green and soybeans in the red and wheat in the blue. This is based on the current USDA projections in the November report, where they took corn exports to 2.65 billion, soybeans at 2.2 billion, and wheat is just under a billion. I think it's like at 975. If you add those all together, you'll come up with a total export program of grains out of the U.S. for this crop year of 5.85 billion bushel, just very close to 6 billion bushel. And you can see even the 5.85, that would be an all-time record. This is going to be a challenge for our system, both from producers getting grain into elevators like New Vision to load on shuttle trains, to get for the railroad to move those shuttle trains to the export terminals, to get unloaded, to meet the vessels, a lot of truck, a lot of transportation. Logistics have to work just about perfect because we are going to be testing the capacity of our system. And right now, this time of the year, we're shipping a lot of beans. Last week's inspections, I think, was over 90 million bushel. You know, at some point, hopefully the beans start slowing down a little bit because we need to start shipping more corn. But this is going to be a very interesting year. The export program for the U.S. on corn and soybean is our relief valve. That's how we are able to get rid of excess stocks, which bring the ending stocks down at the end of the crop year and allow our prices to rally up. Here's a table that comes out each Thursday after the export sales report. It's called the largest importers table. And I just wanted to show this to you to show you the difference. We have corn on top here, and you can see last year almost no corn to China, a good amount of business to Mexico. They're one of our largest customers for US corn. And the unknown category. A lot of the people in the trade will equate a high percentage of this unknown also being Chinese business. So here we see 10.7 million metric ton of corn sales on the books right now with China, you know, and a little over 5 million metric ton of unknown category. So you add those two together, you know, you've got over 16 million metric ton conceivably that could be mostly going to China. But China's TRQ, the import limitations on corn continues to be 7.2 million metric ton. So a lot of the people are questioning when are they going to raise that, because they've bought more than that from the U.S. alone. They've also purchased corn from Brazil. They've also purchased corn from the Ukraine. So at some point that needs to change. We'll talk a little bit more about that later. In the USDA report on November 10th, the USDA number was raised up to 13 million metric ton for total corn imports by China. But you can see there's a good possibility they have more than that purchased from the US already. So what does that mean? Well, the thing we have to be aware of, there's been other instances where China came in and purchased large amounts of US corn, and in one case, they ended up canceling or rolling at least half of what they had purchased. So I think the market's a little bit concerned right now. We need to see these shipments start taking place on corn, and right now they're not quite going at the pace, and that's holding this corn market back a little bit. What about soybeans? Of course, last year we were trying to come out of the trade war with China, about 7.9 million metric ton of soybeans on. This year they're already up to 27.5, and you can see another 10.5 in the unknown category. Once again, a good share of that is probably China. So there's a lot of sales on the books on soybeans, but there's also a lot of unshipped sales on the books with China and unknown. And we want to make sure that they all get executed. Here's a couple of charts from StoneX, and I think this is actually a week behind. We're actually through week 10 now, but because of their requirements with having to have this into compliance before the report, you know, we might be a week late, but the numbers may change a little bit, but the idea is still the same. What this shows are corn export sales through week 9, and here's the estimated final export by the USDA in the line, and the week by week in the blue bars on the bottom. You can see now with this last report, USDA taking their projection up to 2.65. That would be an all-time record for corn exports. So from a sales standpoint, through week 9, we were 206 million above the pace that we needed to be at to meet that projection. But the problem or challenge is from a shipment standpoint, we are 118 million below the seasonal pace that was needed. And right here on this line, this kind of greenish line that comes down right here, this is the current year. Now, if you look from this point forward, we're not starting out very good, because if we're going to have all-time record exports of corn, it should be above all of these lines. And right now it's not. Now, the one encouraging thing when we look at this on corn, here would be the first of the year, January, right here. And you can see it looks like from a historical perspective, corn inspections out of the US tend to start going up after January, February, March, April, May, and continue well into the summer. So maybe this is a situation where we're exporting a lot of beans now, taking a lot of the capacity at the terminals up with export beans. But now, once we start winding that program down, as the Brazilian crop comes available and China takes its demand south, that we see these corn inspections pick up. This is something we need to watch very closely, because remember that 325 million bushel increase in corn export projections by the USDA in the November report. That's what took that carryout down to 1.7 billion. That's what took the price projection up to $4 a bushel. Looking at soybeans, we see a similar type pattern. Sales through week 9, 458 million above the pace. And you can say, well, how could the USDA not change that 2.2 billion bushel export number? And a lot of the trade questioning that. So it all gets down to execution. And on the soybean side, you can see here, here's our current year. We are basically as high as we've been for this time of the year. So we're getting the beans shipped right now, but you can also see that as we get closer to January and February and March, there's a historical tendency that these bean inspections drop off drastically, especially as Brazil starts harvesting their crops and moving into the ports. Right now, if you compare the price of soybeans out of the US for February and the price of soybeans out of Brazil going to China, it's about $15 to $17 a ton cheaper out of Brazil than the US. With that kind of price difference and the currency valuation, China will buy beans from Brazil as soon as they're available. Okay, let's talk a little bit about the South American crop. And then we'll talk about La Nina and see how things may get affected. First of all, just a quick word on the world ending stocks and the change from October to November. Not a big change really. You know, the 300 million metric ton ending stock number in October dropped to 291. Now, some of that was the US crop being a little bit smaller. But the one thing we need to point out here, 8 million metric ton of that ending stock number on corn very likely came from the reduction in the Ukrainian corn crop, where it was changed from 34.5 million metric ton for their new crop to 26.5. Now, a lot of the trade was thinking that crop was getting smaller because they've had some droughty conditions in Ukraine. But they were looking for that crop to come in 28 to 29 million metric ton. USDA coming in at 26.5 is a huge, huge number, because China's number one choice if they want to import corn would be from the Ukraine. And when the Ukrainian crop is getting that much smaller, they will have much less available for export, which means China will have to go to South America or to the US. And right now, if they need corn, it's coming to the US. This Ukrainian number is a big thing. We have to keep an eye on that because I've seen some estimates where they think that crop possibly is getting smaller and could be 25 to 26 million metric ton. And once again, that would almost be a bushel for bushel reduction in further exports if that in fact happens. On the soybean side, 88.7 million metric ton on October 9th, dropped to 86.5. A lot of that slightly smaller crop in the US. But when we look at the changes in Argentina, we see they left the crop unchanged at 50 million metric ton on corn, but 2.5 million metric ton reduction on the soybean crop expected out of Argentina in the coming year. That's La Nina, and we'll talk about that more in a few minutes here. On the Brazilian side of things, corn crop left unchanged at 110, and you compare that to a year ago, a bigger corn crop projected in Brazil than what they harvested this last year. And on soybeans, 133 million metric ton. That would be up from 126 last year. So you can see the La Nina typically does not affect Brazil the way it affects Argentina. It can affect parts of extreme southern Brazil, but not to the degree where they have a crop failure. So we have to be well aware of this opportunity that we may be looking at now with very, very good prices. You know, if they get the timely rains in South America, it's going to cause some interesting things as we get into that last half of our crop year. So we need to be watching very carefully, take advantage of the opportunities as they present themselves. Now let's go to China for a little bit. China is in the process of rebuilding their hog industry after quite a battle, an extensive battle of probably close to 2 years of African swine fever, where they lost a huge amount of their hogs. They say, and when I say they, China says that they're approximately back to 80% of where they were pre-African swine fever with their sow herd, and they're definitely rebuilding. And it kind of makes sense when you look at the numbers. Here's the pork price in blue in China, and we can see definitely down from the 2019 highs because supplies are becoming more available. They are rebuilding their industry. They've been importing a lot of pork from the US, so prices are coming down. Pork is the preferred meat in China, and it's very important from an inflation standpoint, you know, in the Chinese economy, that this pork price does start coming down because that's the #1 item for inflation in China when it comes to the price of food. Also, when we look at the hog feeding margins, last year, this gray line, people were making just tons of money, the ones that were able to keep hogs alive. There were reports that producers at times were making over $400 a head finishing hogs in China if they were able to keep them alive. So we can see that here's our current year in the blue, lower than the highs that they had, but still very profitable. So they're trying to raise as many hogs as they can and get things back on board to provide meat for their people. Now, as they rebuild their hog industry, a major change is taking place. Remember, in years past, pre-African swine fever, a high percentage, probably almost half of the hogs in China or more, were raised in small farms, small family farm type operations. But the problem was a lot of the feed that the hogs were given were table scraps and wastes, and that's really what kind of propagated the African swine fever to a large degree. China has outlawed that practice completely. You're not legally able to feed pork scraps, or I should say table scraps, to your pigs, and because of that, a lot of the smaller farmers are giving up. The new hog industry in China is going to be large, commercialized facilities, kind of like what we have in this country, which means that there's going to be an increased demand for soybean meal and for feed grains because they're going to be fed better rations and probably make better pork. So, you know, it's a major change to China. Some good, some bad, but from a food standpoint and from a demand for corn and beans, it could be good for the American farmer. Now, when we look at the prices, here on your left is the Dalian corn nearby futures market in China. And here's your current price right now, all-time record high prices for corn. In fact, if you equate that back to US price, it would be $9 to $10 a bushel. And that's one reason why it works for the Chinese to buy US corn right now. Because even at $4 a bushel, you add the freight on, I mean, from an economic standpoint, it works. And, you know, especially if they need the corn, there's a lot of analysts out there that feel that the Chinese crop of 260 million metric ton, which is what China says they're going to raise for corn, is about 28 to 30 million metric tons short of what their demand is. So they need corn, or they need a feed grain of some way, shape, or form. Now on the crush margin side, we also see crush margins in the dark blue here. On the soybean side, very strong right now. So it also works for China to be buying beans, and they can't really get any more out of Brazil because they're out of beans until their new crop. So they're coming to the US. The margins look like it's there. From a trade war update, you know, we're into phase one now. In phase one with China, you know, the agreement said 36.5 billion bushel in purchases of US ag in 2020 and 43.5 billion in 2021. Now, to put that in perspective, you might say, well, that just doesn't even seem reasonable. But last year, China as a country bought 124 billion globally from all customers when it came to ag products. So, you know, this would be a higher percentage, but still very achievable. Now, because of COVID, you know, I think there's going to be a little bit of a grace period there. Through September, China had purchased around 13 billion bushel of US ag products. The shipments now through January are going to be very strong. We're probably not going to quite make the number for 2020, but the way they're taking beans and with what prices have done, you know, it could be closer than what we think. Definitely supportive to American agriculture. China buys what it believes it needs. They're really not buying corn and beans and pork and sorghum just because they want to, or just because of phase one. It's because they need the product. Crush margins, as we looked at, are very good. They need the soybean meal to feed their hogs and their poultry to make more meat for their people. They need the corn, but we have to be a little bit careful about assuming that China's going to take only corn, because prices at the levels they're at in China, they will also be looking to do some substitution. And that's why we've seen their wheat auctions pick up as far as what feeders are buying. We've seen good sorghum exports out of the US to China, and also barley. Now, since the election, reports are that China has been asking President-elect Biden for renegotiation of the phase one agreement, saying that they think it's too much one-sided in favor of the US, and they want it to be fair to China. The trade looked at this, and the trade really is questioning if anything is going to get done in a meaningful way, mainly because if you look at a lot of the comments coming out of Washington from both parties, no one wants to be perceived as having a soft or easy stance against China. Both parties agree that there's been some misuse and some abuse that needs to be fixed. So if there is a renegotiation, it may be a situation where we renegotiate part of the ag portfolio of phase one, but get concessions on possibly intellectual property or some of the other sticking points we had before. That's a ways down the road. As one person put it very well, you know, as long as we have COVID around, once President Biden is inaugurated, his top priority is not going to be phase one with China. It's going to be taking care of COVID and some of the other issues in the country. Now, as far as China's corn need, as we mentioned, the USDA raised their import thoughts for China to 13 million metric ton. That would be up from 7.2, which is still what the Chinese government is saying. A week or so ago, the US Ag Attaché in Beijing said that they project the China to raise their TRQ to 22 million metric ton. Now, if we take, you know, what we looked at earlier, say they have 10 to 12 million on the books from the US, 2 to 3 out of Brazil, 3 to 5 out of the Ukraine, you know, they're probably close to that 17 to 20 right now today. The surprise to the corn market, and what really could be a dynamic down the road, would be, we have private estimates out there that they think China could possibly import as much as 30 million metric ton. If that happens, there's a good chance with the smaller Ukrainian crop, remember that 8 million metric ton reduction? Remember the fact that if Brazil plants their beans late, they plant their second crop of corn late, can possibly run into some heat issues as that finishes. So it could bring more demand back to the US. And if, in fact, China were to take 30 million metric ton of corn, that may be something that could take that ending stock number on US corn from 1.7 down to 1.5 or less, which would also take that stock to use ratio on corn possibly under 10%, down to a level where we may have to be thinking about doing a little bit of rationing on corn. That's all potential. It's not in the marketplace today, but we would have to wait and see once it develops. Now, if the Chinese were to raise their imports to this type of level, it would have to be a sign that they are really desperate for feed grain, because it would be a seismic or major shift in their policy. Right now, they've told their people that they are 95 to 96% self-sufficient on feed grains. If they have to import 30 million metric ton of feed grains, they are not self-sufficient. So, you know, it would kind of be egg on their face if they did this. The other thing about it, right now they have very high prices on corn in China, as we said, $9 to $10 a bushel. What should that do? That should encourage the Chinese farmer to raise more corn, which would help them achieve their goal of self-sufficiency. So, you know, they're reluctant, even though from an economic standpoint, they can buy cheaper corn out of the US than what they're paying their producers. You know, in China, it's a different way of thinking. They're more concerned about self-sufficiency. They're more concerned about raising the income of the rural poor, the small farmer out there in the area. So we'll have to wait and see. Longer term, they may not have a choice. If they want to make the meat they need for their people, they may need to continue to be a significant importer of corn from the US, from the Ukraine, from the Brazil, but you know, it would be world demand. Here's a map that shows kind of where we're at with the La Nina. Remember, a La Nina looks at the sea surface temperatures along the equator off the coast of South America, which is what we have right here. If you notice in this little red box, all of these blue and dark blue figures, that's below normal sea surface temperature, signifying that we are in a La Nina. But this La Nina is a little bit different. If you notice the sea surface temperature off the west coast of the United States, it's tans and browns and reds. This is warmer than normal sea surface temperatures. And you see the same thing off the Atlantic coast. This is what's causing a lot of your tropical storms and hurricanes, and we've had a huge amount of them so far this season, because the sea surface temperature is warmer than normal, and that's what generates a lot of these tropical storms. We've got a different situation. Normally, when we see this strong of a La Nina, you see cooler water in other parts of the ocean. Not the case right now. So a lot of meteorologists are having a struggle deciding just what the weather effects are going to be. Here's just a map on your left that shows the main growing areas of Brazil. And I put this up here because the soybean area is in green, the corn area in yellow. And as I said, the La Nina typical affects extreme southern Brazil and Argentina, which would be the area right down here at the bottom. But the #1 state up here at Mato Grosso, I just read an article from AgRural that said they don't think that they can have a record crop in Mato Grosso this year because they've been too dry. They've actually had farmers replanting beans because it's been too dry. So, you know, there are issues going on, and we have to keep a close eye on that. From World Weather, here's the map that they give us for basically the growing season of Brazil and Argentina now from November to January. That would be like the heart of our summer, you know, as we get closer to making that crop. On your left-hand side is the temperature map. On your right-hand side is the precip. You notice here in Argentina and southern Brazil, above the near normal temperatures. And on the precip side, below normal precip. And these areas are extremely dry already. Now they're entering their rainy season in Brazil, and it's going to be very imperative that they do receive moisture. You know, they're going to have a crop down there, but we can still do damage. You know, as that crop, last year's crop was 126 in Brazil. The government came out with a report over the weekend saying they thought it could be as high as 135 this year. USDA is right now at 133. Regardless of the size of that crop, the key thing right now is when does harvest start and when do they start exporting beans? That will have a big influence on what U.S. ending stocks end up with as we get to August 31st of next year. Here's a graph from Stone that shows the Argentina soybean production in the light gray lines and Brazil in the dark blue. The red circles are previous La Niñas. And you can see in most cases, pretty dramatic impact of soybean yields in Argentina due to La Nina. But you can also see that in those same years, the Brazil crop, it can be down a little bit, but usually it's not a disaster. So they're going to be there. It's just a matter of when they're able to start harvesting. Now, what if Argentina has a short crop? We have to keep in mind that Argentina is a country in the world that raises a lot of soybeans, projected at 51 million metric ton, but they tend to crush almost all of their soybeans at their port facilities and export the meal and oil versus the whole soybean. So if Argentina has a short crop and the farmers aren't selling, that could push meal demand back to the US. But we'll look at a chart in a minute that the US crushing industry on the soybean side is just about at capacity, running at a very high rate. And the report that we've seen this morning on the October crush confirmed that once again. So, you know, possibly some of this meal demand, if Argentina can't provide it, would have to go to Brazil. But Brazil's crush plants are inland, and they would have to process the beans and then freight it to the terminals to export, which would make costs higher, which would possibly bring the price of global meal up and possibly take meal away from domestic users in the US. In the US, we have a little bit of an alternative. We have plenty of DDGs. So if the ethanol industry is still running, this may be supportive to them. Here's the chart that basically shows the estimated crush capacity in blue for the US industry, and here's where we're at right now. So, you know, it's pretty close to being at capacity, but we could probably fit in maybe another 20, 25 million bushel if need be. Here's a slide that Arlen always uses, and I think it does a good job of explaining and leads us into prices. Price is the function of supply and demand, but it's overridden or modified by the flow of money. And we can definitely see that when we look at the commodity fund positions as of this last Friday. And what I did is I left the August numbers in there to kind of show us how much this market has changed as this market has rallied. On the 4th of August, the commodity funds were short 195,000 contracts of corn. Going home this past Friday, they were just about long 300,000 contracts. So a swing of almost 500,000 contracts since August when we had our low prices. And we'll point that out again when we get to the price chart in just a second. On the soybean side, about August crop report time, they were a slight long of around 47,000 contracts. Going home last Friday, long 276. So you see the flow of money definitely came into this market to cover their short position. Here's our low on October 7th on nearby corn in Chicago at 307. Remember, that's when they were short almost 200,000 contracts of corn. As they purchased that short position and went long, now almost 300,000 contracts. And we see new highs at 428 on nearby corn in Chicago last week. Now, one other thing to point out on this chart, as you work your marketing plan, keep in mind, we like to track the 9-day RSI or relative strength index. When that gets up to 80 or above, like in the case here, 83.6, that's when we made our high back in October of 422. And the market corrected about 30 cents off of that, you know, overdone RSI of 83. Now, we came up and made new highs after the crop report, but, you know, once again, not a bad time to make a sale when you see that RSI get above 80. Now, if we ever get to a point where the market's bearish, like back in August before this thing took off, you can see the RSI was down close to 20. Then the market drastically oversold, also due for a correction, but the other direction. So as we look at this dramatic move of prices, I wanted to show you the monthly chart because the $1,000,000 question from a lot of people now is, how high can this core market go? When should I look to sell? When we look at a monthly chart to get a long-term perspective, you know, this goes all the way back to 2016, you know, and when the corn carryout gets extremely tight, we're not quite where we were in 2011 and 12. But if we look at the last 5 years, we can see a pretty definite pattern that this corn market tends to run out of gas when we get close to about 440. That happened in 2015, 438 3/4, 2016, 439 1/4. Last year, we made it up to 464, but we didn't stay there very long. And that's the case all along here. You notice this is a monthly chart. So each bar is 1 month. So in 2015, it happened in 1 month. In 2016, 1 month. In 2019, 2 months. So we have to be ready. This market now trading in the low to mid 420s, last week's high 428. Can we go up and test this 440 area on nearby corn? I think we can, but we're going to need something to happen. Either a change in the supply, possibly in that January report, or possibly additional demand as we go forward here. Now, what we have to be careful of is COVID, because the last time we ran into a serious COVID outbreak in March and April, you know, we really cut back on driving. We cut back on gasoline demand. That affected ethanol. We had livestock harvest facilities, you know, shutting down because of COVID. So that can affect demand in a negative way. Now, we've seen the USDA set the bar very high for export. We need to see export inspections pick up on corn, and they need to start happening quickly. Today's inspection report on corn, I think, was only about 32 million bushel. That's not enough. As we get January forward, we're going to need to see those corn inspection numbers week to week go 50 to 60 million bushel each and every week, or we're never going to make that number. So don't lose track of the fact that we are at very good levels. We've rallied a long ways here, and we have to be careful of how long we wait, you know, and don't pass up the opportunity. Now, if you have been aggressive at selling your old crop corn, nothing wrong with that. Yields were good, prices were rallying, that was fine. But don't forget, most of you are probably going to be farming again next year. Here's a chart for December 21 futures, continuation chart just for that month. And you can see when prices were really ugly in July and August, we had that corn, new crop corn price for the crop you're going to be planting this coming spring. It was down around $3.50 a bushel in Chicago. No way you could make that work. Well, this past week, we've traded that as high as almost the 410. And you can see from a life of contract perspective here, you know, we get up to 415 to 420. It may not be a bad time to try and get a little bit of protection on some of that corn that you're going to be planting this spring. When we look at this chart, this is called the price percentages chart. And it looks at corn prices on the nearby contract for the last 5 years. And you can see when we're up in this area, this 420 area or so, we're well above, we're in the upper 10%. That's when you want to be marketing grain. And once again, you can see we don't stay there very long, because at that point, we either attract so many acres back in, or we cut back on demand, and that takes the wind out of the sail, market settles back down. Here's our nearby continuation chart on soybeans. This rally actually started way back in April as we started seeing a little bit of relief from COVID, and it gradually started coming. We've seen some Chinese business, phase one started kicking in. And then once we were to August here, and then started getting some concerns about dryness and yield reduction, and the market went rallying up from about 870 in August to this last week trading up as high as in the low, I think 1160s, 1164 maybe on the January chart. Once again, keep an eye on the RSI. Above 80, that market is getting a little bit toppy, possibly due for a correction. And you can see going home on Friday, that nearby RSI on soybeans up to about 76. So we had made new highs, 1159 on the nearby contract here, but be kind of careful. You know, it's not a bad time to reward the market after the rally we've had. Once again, looking at a bigger picture on the monthly chart of soybeans, where do we think it could go from now? That 190 million bushel carryout is definitely a concerning number. The 4.2% stocks to use ratio, there is no room for error. If we see a yield reduction in January, or if we see additional demand, or another 2 weeks of demand from China because the Brazil harvest is late, that could put us into a rationing mode. And you can see here on the monthly chart, you know, we usually can have a little congestion between $10 and $11 to kind of decide if we're going to get tight or not. But once we start going above $11, you can see a lot of times it quickly goes to 12, and sometimes quickly goes to 13. I am not predicting that. I am telling you that if the things start happening and we see that ending stock projection on beans go from 190 to 150, you know, this thing could be fast and furious. because the job of the market then will be to ration demand, create as much pain on the end user that they say, all right, uncle, I give up, I'm not going to use soybeans, and then all of a sudden we solve our demand situation. What about November of 21 for the soybeans you're going to be planting this spring? Once again, a nice rally off of the COVID lows that we had when we had nearby futures down around 825, 826, traded as high as 1044 this last week. You know, not bad prices to be looking to get some protection on, whether you do that with a hedge to arrive contract, with a put option. You know, we don't stay at these prices for a long time. Now, the interesting thing about it, the company formerly known, I think 2 or 3 name changes ago as Informa, came out with a revised acreage number. And actually, you know, the acreage projections for corn and beans in America in 2021 aren't going up high enough. I mean, these prices are looking like we're going to have a war here between acres. Both prices, 1044 November bean futures, 410 to 415 December corn futures. Both crops need additional acres. So as we get into the spring, it could get real interesting, could be very dynamic as we go forward here. And here's our price percentages chart on soybeans. You can see once again, once we get above 1050 on nearby futures, we are in the upper 10% of where soybean prices have been for the last 5 years. Folks, it wasn't that many months ago, we were in the bottom 10%. So this is something to watch closely. Make sure you don't pass up this opportunity. Here's our closing bid page at New Vision from last Friday, the 13th. And, you know, we always ask the question, what is the market telling us to do? Well, we see a little bit of a carry to December, the January and February. You know, if a person has grain on storage on the farm, you know, and you're looking to position income, need some cash flow, you know, you can get $4 corn. Today the market was a little bit higher. You can get well above $4 even for January. But if you have on-farm storage, have it tucked away in a bin, taken care of, down for the winter, you know, the market's still offering about a 19 to 20 cent carry out into the summer months. Market's telling you if you have farm storage, it's good to sell the carry. Average price projection for the USDA in this report, $4. You know, with today's up in the markets, you know, you're probably able to sell 410 plus for those summer months. Not a bad time to reward the market. Can the market go higher? Yes, if we find more demand. Can the market go lower? Yes, if we see demand contract, mainly because of problems with COVID as we go forward here. What about soybeans? You know, it wasn't that long ago that we had an inverted market where the nearby month was about as high as you could get. You can see actually a little bit of a carry. So as this market's rallied, apparently the market has been able to source enough beans for the processor and for the export terminal now, because there's about a dime carry to January, 15-cent carry to February. Now, what this market is telling you is you definitely don't want to hold your beans past March, because if you do, we go inverted again and see lower prices. Why? Because at this point, more than likely, Brazil has beans in position, the export business goes away, and we possibly see the U.S., you know, kind of picking up the leftovers. So keep a close eye on this. You know, with today's little upboard on beans, at times, you know, you're able to sell $11 plus. Average price projection by the USDA for this crop year was $10.40. But as I said earlier, I think that's too low. I think what they're looking at there is a fair amount of the beans in the U.S. were priced in September and October before this rally really took off. So when they look at that $10.40 price, they're probably bringing in some cheaper beans from the earlier months, thinking that, you know, we can be higher in the middle, but then we get back to the end, we're probably a little bit lower. Not a bad time to reward the market. Here's some take-home points as we wrap things up. And I'm just going to borrow these from Arlen at StoneX because he does as good a job as anybody as summarizing them. And really the corn stocks, as we've talked about, corn stocks are adequate. 1.7 billion bushel is lower. I mean, we reduced it 465 million bushel from October to November, but it's still adequate. But Chinese demand still has growth, and there's that word again, potential. If China comes in and actually imports corn to the tune of 25 to 30 million metric ton, more than likely, more demand comes out of the U.S. That's potential for this carryout to go lower, for corn prices to be able to take that next leg up. Today, we're not quite there. Supply risks focus on South America. The main risk is beans and corn in Argentina and extreme southern Brazil. But there are other parts of Brazil that have not been quite getting as much rain as they'd like to see. We'll have to wait and see how this all pans out. Brazil's going to have a crop. They're going to have another big crop because they've planted more acres and their farmers are looking at these prices and they're doing everything they can to maximize their production. Election demand risks linger, and the biggest risk there that the market fears is a national shutdown or restrictions on travel so that we slow down gasoline demand, fuel demand, biodiesel demand for buses and cities, and that affects, the demand tables for both corn and beans. Soybean stocks have no room for error. 4.2 stocks to use ratio, second tightest in history, and it doesn't take much now to put that into a extreme pre-rationing mode. Risk number one for that ending stock number on beans is the extension of the U.S. export season. Right now, the market's been kind of positioned thinking that by 1st of February, this business from China shifts south to Brazil. But what if Brazil doesn't start their harvest until the 15th of February and then has to get the beans into position? And what if that 2 weeks business from China continues to come and it comes to the U.S.? A half a month of demand into China would just about conceivably take another 100 million bushel away from that ending stock number on soybeans. Now, we can't get too low. We'll never run out. We'll never go to zero because price will ration that demand. Risk number two would be actual South American production losses. This La Nina completely fools everybody, and the damage is worse in Argentina than what we anticipate. And in fact, it actually damages the Brazilian crop. Then we have all kinds of fun things happening in the future. As we wrap up, I want to leave you with this. I always like to leave you with just a little bit of a piece as far as something other than grain, because there's so much more to that in life. A week from this Thursday, November 26th, is the day of National Thanksgiving in the United States. Isn't it great that we live in a country that we're actually allowed to celebrate a day like this and to worship our Lord and Maker? I picked this little phrase up out of a devotional I was reading, and I want to share it with you. And I'd like you to think about this and maybe read it to yourself or read it to your family during your Thanksgiving festivities. Today, the Lord's bounty comes to our homes. Gather around the table, ours and the Lord's. We are given life and bound with saints past and present. 2020 has been a challenge for everybody. Families that have lost loved ones, COVID, weather challenges. There's been all kinds of things. But one thing we always have to remember is this is just temporary here. And I was listening to a webinar on a church service yesterday, and they talked about the fact that grace comes from Jesus. And Jesus has promised, our great God has promised us that his grace is always sufficient for any and all problems we're ever going to face. Don't ever forget that. I wish you a happy Thanksgiving. Thank you for participating in this webinar. And here are the names and addresses of our current origination staff: Jim Den Hartog, Joel Hartzell, and John Varley. They're more than willing. In fact, they're eager to work with you, set up a marketing plan to help you maximize profits in your operation. I want to thank you. Here's my contact information. Thank the New Vision employees that help get all this stuff out onto the airwaves and everything. We'll more than likely be following this up with another webinar after the December 10th supply and demand update. For those of you that may be visiting, not real familiar with New Vision, we've got a pretty good footprint. Here's a map of all our facilities. We have programs, we have policies, we have prices that can help you in your operation. And our motto that each and every employee works for every day is to provide service and value every day. With that, it's a great day to be alive. Have a wonderful remainder of 2020. Look forward to working with you in the future. Thank you and have a great day.